This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Tuesday, May 14th, 2024 edition of InvestTalk. I'm Justin Klein, and I'm here for you. That's what this show is about. It's to help guide you through the maze of headlines and data points that flood your inbox, your personal inbox, each and every day, and then feeds on your natural emotions. That's what we are. We're human beings. We are emotional beings. And therefore, our first reaction to most data inputs are emotional. Whether that's fear or greed, which is the most common thing in the investment world, the most common emotion. Or maybe it's excitement or disgust or whatever it is, it's an emotion. As opposed to taking that data point, balancing it out with the other data points, and finding to a clear consensus based on the realities on the ground. So many people get caught up in the politics of it, the lens at which they view the world. And the reality is, how is the market viewing this data point in aggregate? Because that's what markets are, right? It's a mix of aggregate opinions across various asset classes, different companies, etc. And so here on today's show, I'm trying to help you see through all that and focus on the realities on the ground, which you can see if you kind of clear out a lot of your bias. And so I'm here to give you some actionable material, some feedback on your questions, and give you topics that I think are important for you to understand and take in your full decision-making process. It's not just about one data point. It's like we always say, you don't chase the yield. You don't just look at a dividend yield and say, that's what I want to buy because it has the X dividend yield. It's not the way to invest. And you could apply that to any asset. Oh, the growth is X, or the interest rate is X. It's looking at all sides and seeing if that fits you. So it's about education and having the right mindset to make those investment decisions, which is unemotional. Now we're going to look at the market performance for today, as well as run down some show topics. But as usual, we are going to tackle our first caller question now.
Hey guys, I was hoping you guys could do an evaluation of Vertiv Holdings Co., VRT. I like the sector it's in. It's also shot up a lot as of the past year. I'm just looking to see if it's too expensive. I know you guys talk about good companies at good prices. I'd like to know if it's either one of those two things, hopefully both. I'll listen on the show. Bye.
All right, looking at Vertiv, and let's see, this is in the tech space. Okay, it's a tech equipment company. Oh, excuse me, I'm sorry. It manufactures hardware, software, analytics for ensuring vital applications are run seamlessly. When you're talking about data centers, communication networks, commercial industrial facilities, etc. So it helps make sure all of those systems are running smooth. Now it has run up in a dramatic fashion. Back in, when was this? Last spring. So a little over a year ago, it was trading at $12 per share. Now it's at $98 per share. 98. That's pretty extreme. So it's earning $3 per share next year at a called $99 close today. So 33 times forward-looking earnings. But my issue here is that growth has slowed dramatically. And historically, this is a company that's gone from profitable to unprofitable and then back to profitable. So it's been fairly inconsistent in that way. And that's what worries me, is this recent surge real? And growth, while a year ago was growing 32% on the top line, earnings were up 400% in early to mid 2023, second and third quarter. This last quarter, earnings were up 79%. Revenue's only up 8%. So growth is certainly slowing here. So I think this is a name that's interesting, should be on maybe your watch list, but not a name that you want to, I think, jump on at this time. The momentum is certainly waning, and I don't think after this run it is it's at an attractive valuation. Thanks for the call. Now we're going into a short break, and on the other side, we'll talk about today's planned topics as well as the market activity. And please remember that you can call anytime and leave your question on the InvestTalk voice bank. If you're listening via our live stream or on AM 1220 in the Silicon Valley area, you can call right now at 888-99-CHART.
You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success.
Now, we have a lot of ground to cover the next 45 minutes, and our main focus point is in regards to grants for first-time homebuyers. A lot of people, I don't think, know about this, but there are many types of grants, gifts basically, that you can get if you are a first-time homebuyer. So we're going to go through some that you can get from actually a bank, others on the federal level, and then others the state and local level as well. So that's our main focus point. But in regards to our others, we're going to look at copper demand, and companies and even countries around the world are looking to secure more copper production. And so we're going to look at that story. Also, there's a confusing narrative coming out of the energy industry, oil and gas, in the United States that kind of clashes with the numbers, which is, guess what? We produce more oil today than we ever have in this country. Now, how much of that is due to the industry as a whole, despite the roadblocks that the Biden administration have put up, or have those roadblocks been overblown? Yes, there's been roadblocks, but how much impact have they really had? So we're going to look at that in more detail and figure out, and I think there's some lessons here, and it actually applies to not just the oil and gas industry and politics, but other industries and how that intertwines with politics as well. So we're going to look at that. And then lastly, buybacks. Buybacks are back. Companies are repurchasing their shares in a big way, and especially those larger companies. So we're going to look at those data points and see where money is flowing from the corporations and which one is going to have the most impact. Okay. So that's what's on the docket for us today. We also have some voice bank questions. One is on Sony Group, SONY, and then UFPI Industries, or UFP Industries, excuse me. And we have some questions that came in via the comment section over on our YouTube channel as well. And of course, I welcome your finance and investment questions right now at 888-99-CHART. Now let's take a look at the market today. We had the CPI number, and that came in a little hotter than expected. And at about 2.37% year over year on the core side, 50 basis points month over month, although the previous month was downgraded to negative 0.1%. So, well, you had, sorry, it wasn't CPI. This was producer price index, which typically feeds into CPI. And I always think this is a more interesting data point. Once again, that was the previous month was revised downward, and this was actually a beat to the upside. So, net, it was a mild beat. I think much more mild than the headlines are making it out. Okay. And if you look at where interest rates went, they were down a little bit. So didn't really spook the market in regards to inflation expectations or Fed policy expectations. To be frank, I think it was a bit overblown, at least. And the market kind of shrugged it off. Market really shrugged it off. It tried to break down early in the morning, and then we had a rally late in the day, and small caps did the best. Partly because rates were down. Small caps were up about 1.1% on the day. The broader large caps were up about 0.5% on the day. We still had some of the echo effects of the meme stock craze that was ignited yesterday. You still had GameStop up 60% today. AMC Theaters up 31%. And that's even after they announced they're issuing more shares. It just shows you, it's not something that's sustainable. AMC, GameStop, they love this, and they're taking advantage by selling shares and ultimately diluting shareholders. So, the game continues, but it's not a game that usually anybody wins. Plug Power, that was up 19%, probably one of the worst business models in the history of public markets. Just never, ever comes close to making money, and it was up 20% today on this. So short interest is bad once again. Tesla up 3%. And so you're getting a bit of short squeeze right now, and that certainly is helping some parts of the market, especially those smaller cap names. Pretty much all the most active companies in the marketplace today were up in some way, shape, or form due to that short covering rally. What were the losers today? Alibaba, that was down 6%. And that was really the main loser. VinFast, after being up big yesterday. So, this is a market that remains relatively buoyant, and certainly a meme stock craze is going to help that, at least in the near term. Now, you probably noticed that we are answering questions submitted via our YouTube channel in the comments section. And this one came in earlier today. It's by Sam I Am. Says, I want to buy a couple of call, calendar, or time spreads on the stock Shopify. If the technicals improve, I think there's an opportunity to harvest some income in the price movement. I'm looking at selling front month strikes at 65 to expire June 7th and buying July 19th at 65 for a cost around $97 per contract. Ideally, I want to short the leg to expire worthless and my long leg to be in the money. Okay, so basically what he's doing is selling and buying the same strike, okay? But he's selling, it looks like, further out? Oh, sorry, he's buying the calendar strike. He's selling the short month, buying the longer strike. I don't know if I love this. You're kind of playing a bounce off of some support. And let me give you a support level on Shopify. This had earnings. The earnings were poor. It's now below, it looks like, support. The next support level will be around 53. And this would have to bounce back to 70 is going to be some resistance. So that's really what you're banking on. That it's going to bounce all the way back to resistance by July. So 2 months from now. Could it? Sure. But the technicals are now broken. So I think any bounce, this is probably not going to have much legs. So this is not the name that I would do it on. Once again, bad earnings. It's into near-term support and could find a little bit of bounce, but overall, I think this is headed much lower. This is InvestTalk, now with more than 58.7 million downloads, and I'm heading into a short break. So please give me a call now at 888-99-CHART.
Hey InvestTalk community, Justin and Luke here. We are so thankful you've been with us through this investing journey, but we are just getting started.
That's right, Justin. We're excited to bring you more exclusive content. Think more of the critical analysis and expert advice that you love.
You'll get insights into smart investing strategies to help you navigate these turbulent times.
Don't miss our live Q&A sessions every weekday at 4 p.m. Pacific, where we answer your burning investment questions.
Just call our InvestTalk listener line at 888-99-CHART, leave your question, and we'll tackle them on the next show. Who knows? Your question could be the next big topic we explore together.
So stay tuned and call 888-99-CHART to leave your comments. We're here to make investing accessible, understandable, and hopefully even a little more fun.
Chart your path to financial freedom here with the InvestTalk podcast.
Now, our main focus point is about first-time homebuyer grants, and most people don't know about these. And there are many types of grants, basically gifts, to help borrowers, especially first-time and low-income borrowers, make their down payment and get into a home. And this is at the federal, state, and local level, as well as nonprofits and community organizations, and some that come from banks themselves. Now, I don't know if you know this. I know it's kind of misleading because first-time home buyer sounds like, hey, somebody who's never bought a home. Well, the reality is you basically you have to have not bought or owned a principal residence in the last 3 years to qualify as a first-time home buyer. That's how most government and financial institutions qualify you as such. And once again, there are many programs throughout the country, and standards do vary a little bit. And you have to check to see if you fall under that. You usually have to have it as your primary residence. You can't do this for an investment property. And there's typically income and home price limits as well. But let's go over some. Now, Bank of America offers $7,500 to lower mortgage rates for first-time home buyers and low and income buyers as well. Bank of America has a down payment grant offering 3% of the house price up to $10,000 in select markets. Now, that's a big thing with a lot of these grants, especially on the bank level, is they are limited to certain markets, certain areas. Now, Chase has one for eligible borrowers up to $7,500 to lower their interest rate and put towards closing costs, maybe even bolster down payment as well in 15 markets: Atlanta, Chicago, Dallas, Los Angeles, Miami, New York, San Diego, and more. Wells Fargo, they have the most, $10,000 towards a down payment. The buyers who make no more than 120% of the median income in 8 metro areas, including Atlanta, Baltimore, Dallas, Minneapolis, New York, and Philadelphia. Okay, PNC has one. It's $5,000 credit to be put towards down payment, closing costs, fixed costs, etc. But you have to have household income no more than 80% of your area's median income, or the property must be located in a qualifying community. So once again, there are caveats here, but it's definitely something everybody should look into in some way, shape, or form if you're looking for some level of assistance, especially if you aren't a big earner. There's ways that these banks can help. Citibank has a $7,500 credit in certain areas as well. Now, on the federal side, federal programs, there's the Fannie Mae Home Path program, gives buyers up to 3% towards closing on a Fannie Mae property. Now, these are typically properties that have been foreclosed on or short sold. So think ones that Fannie Mae wrote a mortgage on, they defaulted, and Fannie takes control of that particular property. Now, usually they're not in good condition, but hey, may be worthwhile to check that one out. And then there is the HUD, the Housing and Urban Development Program, the Good Neighbor Next Door Grant. And this is available to teachers, firefighters, police officers, EMTs buying a home in their area that they serve. And what's interesting here is they cover up to 50% of the cost of the home, provided that you have not purchased a home in the last 12 months and you agree to stay in the property for at least 3 years. That's probably the most attractive one. So if you are in that line of work, teacher, firefighter, police officer, EMT, or maybe a family member is, you could qualify. Now you have to choose from a list of properties, and usually these are HUD designated revitalization areas. So once again, limited, but something to look into and see if there's some overlap there. And then there's a bunch on the state and local level. You're talking hundreds of programs. And there's actually a database that Freddie Mac has. If you go to freddiemac.com, and then there's a provider network. And so I would check those out there. But Texas has one very similar to that HUD one, where it covers educators, police officers, firefighters, and other public servants. So maybe a little bit broader. Cover up to 2% of the total loan and closing costs as well. But you need to not earn more than 80% of the area's median income. Okay. New York City has one up to $100,000 towards down payments and closing costs. Once again, you have to be a low-income buyer. So there's just a lot out there. The National Homebuyers Fund, it's a nonprofit that supports affordable housing, provides up to 5% of the home purchase price to borrowers who agree to make the property their primary residence for at least 5 years. So that's another one to look into. It's a nonprofit National Homebuyers Fund. So the long story short here is there's a lot. If you don't feel like you can buy a home, there are grant programs, nonprofits, even bank can help you out, and I would certainly look into that. Okay. Now, on the next Invest Talk, we'll look into this topic. Retailers are cracking down on returns and tracking problem customers. Now, according to the National Retail Federation, shoppers racked up more than $5 trillion worth of retail sales in the U.S. in 2023, and about 14.5% of those sales were returned. So what headache is that causing for retailers? We'll dig into that story tomorrow. But for now, I'm Justin Klein. We're ready to take your calls at 888-99-CHART.
You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART. Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation.
Hello, I had a question about Sony. So it popped up recently on one of my screeners. It hit their 52-week low. But, you know, this is a company that has been going on for quite some time. They have about, I think, $14 billion in long-term debt, but then also they have cash and cash equivalents of about $14 million based off of their last year-end financials. I believe the next 2024 financials are coming out, I would imagine, sometime soon. And so I was just wondering, either I have old data here or maybe it was already released, but I was thinking on buying Sony at a long-term hold. Just wanted to get your opinion on it. I do see that they have about $69 billion in current liabilities, but I think the company will be able to work it out. Let me know what you think. Thanks.
All right, looking at Sony, I don't think I need to explain who Sony is, although maybe I need to explain what Sony does now. Sony has been around a long time, but it's evolved throughout the years. Obviously, we have Sony PlayStation, and PlayStation is still a behemoth within the gaming industry, but they are a top producer of image sensors, for example, professional broadcast cameras, music publishing. Sony Music is huge. And so, they make digital cameras, earphones, Sony movies. They have a movie studio. They also, I don't know if you know this, but they have a life and non-life insurance business and other financial services. So it's all over the board, but it all comes out to a very large business, about $100 billion market cap. And the caller was asking a lot about their debt. Their net debt is only about $8 billion. So they have a pretty solid balance sheet. Their return on equity is around 12, which is good. It's lower than their 5-year average, which is closer to 14. So it's a solid business. Now, it has come down recently, and I would say it's a pretty good value at these levels. So it would be more of a play on Japan. Japan's made a lot of structural changes to corporate governance and things like that is generally giving a lift to Japanese companies in general. And most of Sony's revenues comes outside of Japan. So, from a currency perspective, you're not too worried nearly as much about the yen as you would for other Japanese companies that mainly have business within Japan. Now, you did a nice update today. I'm not sure what the news was, but it looks like it's reversing this recent drop. So I'm actually going to give this a thumbs up for your Japan exposure, foreign exposure. If you're looking for that, you're hard pressed to find a better company in Japan than Sony. Thanks for the call. Now let's touch a bit on on copper. There we go, copper. And BHP recently tried to take over Anglo American. Now it was rejected, but it puts a fresh spotlight on the increasing demand for copper, and that's the main reason BHP was trying to buy Anglo American. And right after that deal was rejected, Anglo American announced a turnaround plan. What do they plan to do? They plan to sell off their platinum, diamond, and steel making coal business. So you're talking about metallurgical coal. And coalescing around mainly their copper business as central to the future of the company. And there's obvious reason why this is happening. Copper demand continues to rise, and there is production falling off around the world. Copper futures are up 20% this year, and it's become strategic. Here in the United States, we don't have a Ministry of Mining, for example, but we're trying to secure more metals for national security reasons. And so the government is currently working with private companies, both home, here in the US and abroad, to try to secure more supply. Now, the Wall Street Journal reported last year the US and Saudi Arabia held talks for a potential agreement in the the Democratic Republic of Congo, where Saudi Arabia would take a stake in some mines, and the U.S. would basically guarantee security and that production, the rights of that production. And there's not a lot of new supply coming around the world, and it takes between 7 and up to 15 years before a copper mine even enters production from first discovery. And this is what I talk about all the time. It's not just demand, but it's supply. And copper, you're getting it from both sides. You're getting more demand, and not nearly enough supply coming on board. And in some ways, when you have a multipolar world that we're entering, where you have China and Russia in the east, those aligned with those countries, and then you have the West. And those in the West are trying to diversify their sources of raw materials away from, especially, Russia. Because that was something that was underappreciated post-Cold War, is that suddenly the economy of Russia was open to the rest of the world. And most importantly for the rest of the world, it was their raw materials. You just see that with natural gas flowing to Germany, and the German industrial base grew dramatically because of cheap Russian natural gas. But that's not the only thing they exported. Lots of raw materials, including copper, uranium, many other types of minerals. And some minerals are abundant outside of Russia, and others are more limited. And copper is one of those that is more limited. And this has become a national security issue, not just for the United States, but for China as well. China spent more than $19 billion last year on metal and mining investments, up 158 from the previous year, from 2022. That's the highest level since 2013. And so it's pretty clear that it's not just companies or the market that's waking up to the limited supply of copper. It's countries that are trying to find a way to secure that, and they're going to pay up for it as well. And that's another reason why you continue to see copper prices head higher. Now, here's another question from our InvestTalk YouTube channel. Audio Obsession says, is there a better day of the week that a covered call should be rolled? How close to expiration should one wait typically before rolling said covered call? That's pretty simple. There's a curve, a time decay that every option has, and it speeds up as you get closer to expiration. And so typically the last couple of weeks is when you want to wait till then to start rolling your call options. Now, some of that's strategic. If you're in the money and you want to roll it up and out, maybe you wait for a down day. So a lot of it is depending on the day. But generally the last couple of weeks, that's where we roll into the following month. And that's the way you want to think about it. Try to capture as much of that time decay as you can, while also doing it in an advantageous way, depending on if you're rolling up in strike, meaning maybe the strike price today is 80, you want to roll it up to 85, that would be rolling it out and up. Maybe you want to keep it at 80, okay? Now, if you're rolling out and up, you want to do it maybe on a day where the stock is down. And then, if you're rolling it same strike, at 80, say, then you want to do it maybe when the stock is up. So a lot depends on that. But from a time perspective, you want to look at it in the last couple of weeks to roll. Thanks for the call. Or thanks for the question via our YouTube channel. Now let's pivot back to the InvestTalk Voice Bank. This question came in earlier from Atlanta.
Hey, this is Andrew from Atlanta. I was trying to get in touch with Justin or Lou, trying to reach out to you guys about UFP Industries Incorporated. Ticker symbol UFP, like Paul I. You guys put me on this one. I've held it. I've done well with it. Would like to look into picking up some more. I'm curious if you could tell me how the stock looks going forward, and if I wanted to pick up more, what would be a good price to look for? I appreciate the show. Thanks, guys.
All right, UFP Industries is a supplier of lumber to the manufactured housing industry, and we know we have a housing shortage in this country, and this is a name that's been in high demand, or its products are in high demand. Earnings this year are supposed to be $7.71 per share. Now that is down 5% from last year, but well above pre-pandemic levels of $2.91 per share. $121 stock supposed to earn $8.41 next year. So forward-looking earnings about 15 times. Not bad. Although sales last quarter were down 10%. That's much better, though, than a year ago. Sales were down 30%. So you're starting to see a company that did very well during COVID. Their business right-sized a little bit, right? You had a reversion to the mean. They earned nearly $11 per share in 2022 and $8.07 last year. So you had that step back last year. But you're starting to see this decline level out around $7, $8. And that's what I talk about a lot is these COVID stocks. They had this big earnings jump, and then you have a reversion to the mean, and a lot of those are going to go all the way back to pre-COVID earnings, and some of them are going to plateau at a higher level, and a lot of those that plateau at a much higher level are going to be great buys. And this looks like one of those names. Okay, 1% dividend yield. It has been kind of consolidating and pulling back here since December when it peaked out around $127 per share. Its bottom back in February was about 108. Now we're at 121. The technicals are improving. I think this looks ready to make another run. If you want to buy more, I would just buy it. Now we still take questions via iTunes, and let's take a moment to reward someone who left a podcast review. The Puma 51 says, I was curious about USDT Tether and what your thoughts are on it. Just looking for some insights on this stable coin. I haven't, this is actually a better question for Luke. He is a little bit more of the crypto guy than I am. I am not a big fan of Tether. I think the last time I focused on it, there was some questions about the auditing, and any questions, if there are any red flags within crypto, I just stay away. I just wouldn't mess with it. I don't think stable coins are really worth it, because you're putting your money, or let's just say assets, into something that is still unproven. Yes, it's been around for a few years, but at the end of the day, that's not enough, right? It hasn't gone through different cycles. There's not the regulatory structure that's needed. And guess what? You can go buy a short-term treasury now yielding 5+%. That's effectively a stable coin. And it's much safer, much more regulated, etc. So I wouldn't mess with the stable coins, especially Tether. Thanks for the review. Now, let's go touch a bit on the oil industry. And this is a hot topic heading into the election. And coming out of the last election, there was a lot of promises by the Biden administration to crack down on the oil industry due to climate change. And he brought in environmental rules in regards to offshore leasing, suspended new licenses for LNG terminals, and new environmental regulations in general. And this has hit sentiment, I think, with a lot of voters, especially those that see energy prices going up. But how much of that is Ukraine war versus actual supply being cut off? And the reality is, if you look at the data, the supply isn't really being cut off. In fact, we're producing more oil and gas in the United States last year in history. Actually, the most any country has ever produced ever. And 2022 was the most profitable year on record for publicly traded U.S. oil companies. And profits are almost triple the amount in the same period under Biden as they were under the Trump administration. And if you talk to anybody in the industry, they'll say the Biden administration has put up a lot of roadblocks. The problem is those roadblocks are not manifesting in a dramatic drop in production. And actually, that's inconvenient for both sides, right? Because you can make the argument that there'd be more if he didn't put up any regulation, and that would be an argument for those on the right. And vice versa, maybe the ones on the left are saying those roadblocks are not big enough. Okay? But the reality here is that you have to not listen to talking points when it comes to whether one administration is good or bad for an industry. Because it's pretty clear that from a price perspective, an earnings perspective, a cash flow perspective, the Biden administration has been better for the oil industry. From a business perspective, you can argue in other ways. And I think of this a lot like the gun industry, right? When there's somebody in power that, like Obama was in power, everyone says he's going to take away your guns. Gun sales went through the roof. Then the Trump administration came in, gun sales plummeted. Why? Because no one was worried about the guns being taken. So don't listen to the narrative, focus on the facts. Now we're heading to a break. Give me a call now at 888-99-CHART.
Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. Welcome to the InvestTalk podcast. 'Talk podcast. 'Talk 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 '
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation.
Hello, Justin and Luke. I'm calling today about two IT companies, CDW Corporation, ticker symbol CDW, and EPAM Systems Inc., ticker symbol EPAM. I like their growth and their profitability, but is it the right time to buy? Thank you. I'll be listening on the podcast.
All right, looking at CDW, it's a provider of IT solutions to small, medium, and large businesses. It has fallen recently, and the technicals are looking a bit suspect. It fell back on May 1st, and it's been consolidating that drop ever since. I'm assuming that was on earnings. Earnings were down 5%, revenues were down 5%, and it looks like you're seeing a reversion to the mean there. So I don't like those recent trends, and it's trading at above market multiple. EPAM also looks pretty rough from a technical perspective. It is now at a 52-week low. Earnings last quarter were flat year over year, but revenues were down 4% year over year. No dividend there. And what they do, they provide outsourced IT software development services. I like that business a bit better. Let me take a look at some of the profitability metrics here, because the technicals are definitely down in the dumps. EPAM peaked back in 2021 at $700, around $700 per share. Now it's at $187. Okay. Let me look at the multiples it's still trading at. Yeah, price of sales too. That's not bad. You know, EPAM looks definitely cheaper, definitely better, but neither have the technicals that really line up here. Okay, I would need a sign of reversal, a sign of capitulation, and a higher low. This just has been making series of lower highs and lower lows over the past couple of months. So I don't think either one of these are ready to purchase yet. Interesting names. I like that they're both profitable, but I'm not buying either of these at the current moment. Thanks for the call. Now, lastly, let's talk a bit about buybacks. And we are pretty much through earnings season. And of the S&P 500 companies that have reported earnings in the first quarter, this is as of Monday, they've announced $181.2 billion of share buybacks during the first quarter. That's up 16% year over year. That's led by companies like Meta, Apple, Caterpillar, Cigna, Altria, and Wells Fargo. And of all 443 companies that have announced a buyback plan this year, that's up 378 from a year ago. So from 378 all the way to 443. And remember last year, a lot of companies cut their share buyback programs, or many of them eliminated them. 2022, you saw a 2023, you saw a 14% decline in buybacks. That's the second largest annual decline since the GFC in 2008. Now, a lot of that is because in 2022, there was a rush to avoid the 1% buyback tax that was implemented last year. And then a lot of companies kind of pulled back for a little bit. But now they're saying, okay, we have too much cash. We don't know what to do with it. We don't have proper projects to deploy this capital into. And so I'm just going to buy back shares. And, you know, historically, they do that at the wrong time. So it depends on the company. It depends how strong their balance sheet really is. Some companies do it. They allow their balance sheet to lever up. They buy back at the wrong time, and they're just trying to juice their earnings per share, because it does help in earnings per share when you buy back shares, because they don't have any other ideas. It's a simple way to boost EPS. So it definitely is company by company to figure out whether or not it's smart to do a buyback at the current time. Now, overall, Goldman Sachs projects that S&P 500 repurchases will reach $925 billion this year and over $1 trillion next year. That'd be a 13 and a 16% growth year over year, respectively. So there's a lot of confidence, a lot more confidence at least than last year, in the economy and company balance sheets in order to initiate these buyback programs. But I wanted to highlight that because it's certainly an important flow that goes into markets on a consistent basis. And when you have the vast majority of S&P 500 companies buying back shares, that certainly is a nice bid to stocks overall. Well, that about does it. Thank you for tuning in. I'm Justin Klein. That completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.